The current real estate market is experiencing a unique blend of factors that have sparked conversations about a potential housing bubble. Historically low mortgage rates during the pandemic fueled a surge in home buying, driving up prices and reducing inventory levels. Many people took advantage of these favorable borrowing conditions, leading to intense competition for homes and rapid price increases across many markets. However, the Federal Reserve's decision to raise interest rates to combat inflation has significantly increased mortgage rates. This shift has cooled the buying frenzy as higher borrowing costs have deterred potential buyers, impacting demand. Adding to this complexity is the recent massive jump in housing inventory in certain areas such as Florida and Arizona. Markets that saw significant price increases during the pandemic are now experiencing an influx of available homes. This can be attributed to higher mortgage rates, reducing buyer demand, coupled with more sellers trying to capitalize on high prices before a potential downturn. The sudden increase in inventory is causing market corrections and could indicate broader shifts within the real estate landscape. As a result, some areas are witnessing a slowdown in price growth, while others may be on the brink of price declines. These dynamics create a volatile and uncertain market where significant corrections coexist with continued fluctuations. The interplay between soaring home prices, changing interest rates, and varying inventory levels makes predicting the market's trajectory challenging. Real estate professionals and analysts are divided on whether these trends signal an impending bubble burst or if they represent natural market adjustments. As the market evolves, it remains a subject of intense debate and scrutiny among experts, with each factor playing a crucial role in shaping the future of real estate. Historically, a housing bubble is characterized by rapid increases in real property valuations until they reach unsustainable levels and then decline. This situation often involves speculative investments and over-leveraging by buyers, leading to a market correction or crash. For example, during the early 2000s, the United States experienced a significant housing bubble driven by subprime mortgages and speculative buying, which culminated in the 2008 financial crisis. While the current market shows some similarities, such as rapid price appreciation and intense buyer competition, there are also key differences. Today's lending standards are stricter, with a higher percentage of buyers having good credit scores and larger down payments, reducing the likelihood of widespread defaults. Moreover, the inventory shortage is a crucial factor. In many markets, there aren't enough homes to meet demand, exacerbated by supply chain issues and labor shortages in the construction industry. This lack of supply, combined with robust demand driven by millennials reaching prime home buying age and increased flexibility in remote work, has contributed to the upward pressure on home prices. However, the recent rise in mortgage rates in response to the Federal Reserve's efforts to combat inflation has started to cool the housing market. Higher interest rates make borrowing more expensive, which can dampen demand as potential buyers find they can afford less. This can lead to a slowdown in price increases or even a stabilization of prices in some areas. Another consideration is the regional variability in the housing market. While some areas, particularly those with strong job markets and attractive amenities, have seen astronomical price gains, other regions have experienced more modest growth. This unevenness means that while some markets may be at risk of a correction, others may continue to experience steady, sustainable growth. For instance, cities like Austin, Texas, and Boise, Idaho have seen dramatic increases in home prices due to an influx of tech workers and remote employees relocating from more expensive areas. Conversely, markets in part of the Midwest have seen more moderate appreciation, reflecting different economic conditions and population trends. Whether the current real estate market is heading toward a bubble burst or undergoing natural market fluctuations depends on various factors, including lending practices, inventory levels, and regional economic conditions. While some signs point to potential risks, other indicators suggest that the market could stabilize without a dramatic correction. Prospective buyers and investors should conduct thorough research and consider their financial situation carefully before making decisions. Understanding market insights is essential for making informed financial decisions, especially when it comes to real estate. Whether you're looking to buy your first home, invest in rental properties, or stay informed about market trends, you need a perspective that can help you make sound choices for your financial future. It's crucial to examine the factors fueling speculation about a potential housing bubble and its implications. The combination of skyrocketing home prices, limited housing inventory, and fluctuating interest rates has created a perfect storm, raising concerns among industry experts and investors. Experts have weighed in on the stability of the real estate market, offering contrasting opinions on whether the current trends are sustainable or if they signal an impending bubble burst. Some argue that the market is experiencing a natural cycle of growth and demand, while others warn of the risks associated with inflated prices and the potential for a market correction. To understand the current real estate landscape, let's turn to statistical data and case studies shedding light on market trends. Home prices have surged to unprecedented levels in many regions, outpacing wage growth and making home ownership increasingly unattainable for many prospective buyers. Additionally, the lack of housing inventory has intensified competition among buyers, leading to bidding wars and driving prices higher. Situations in major metropolitan areas reveal stark disparities in housing affordability and the challenges buyers and sellers face in navigating current market conditions. Analyzing these trends and expert opinions shows the real estate market is at a crossroads, with significant shifts potentially coming in the next few years. Economic factors play a pivotal role in shaping the stability and performance of the real estate market, influencing everything from housing prices to market demand. Key economic indicators such as interest rates, inflation, and economic growth significantly impact the dynamics of the real estate sector. Interest rates are a critical driver of real estate trends, as they directly affect borrowing costs for home buyers and investors. When interest rates are low, mortgage rates become more affordable, stimulating demand for housing and driving up prices. Conversely, rising interest rates can dampen demand and lead to a slowdown in the real estate market. By closely monitoring interest rate movements, investors and industry professionals can anticipate shifts in market activity and adjust their strategies accordingly. Inflation is another economic factor that can influence real estate trends, as it erodes the purchasing power of consumers and impacts the cost of living. Inflationary pressures can drive up housing prices and rental rates, making homeownership less attainable for many individuals. Understanding the relationship between inflation and real estate performance is crucial for assessing market conditions and making informed investment decisions. Currently, the U.S. is facing high inflation rates, which the Federal Reserve is addressing by raising interest rates. These actions have led to a noticeable increase in mortgage rates, significantly impacting the real estate market. The cost of borrowing has increased, making it more expensive for potential buyers to secure loans, which in turn has cooled the demand for housing. This situation is further complicated by rising prices of goods and services, which reduce disposable income and make homeownership less attainable for many. The result is a mixed market, where certain areas are seeing an increase in available homes, while others are experiencing slower price growth or even price declines. This combination of factors underscores the complexity of the current real estate market and the importance of careful analysis and strategic planning for both buyers and investors. Geopolitical events and global economic conditions significantly influence the U.S. real estate market, impacting investor confidence, trade dynamics, and currency fluctuations. For example, ongoing U.S.-China trade tensions have increased the cost of construction materials due to tariffs, affecting housing prices. The Russia-Ukraine conflict has disrupted global energy supplies, leading to higher energy costs, which in turn increase the cost of construction and maintenance. Additionally, economic sanctions against countries like Russia have led to fluctuations in currency values and increased market uncertainty, affecting foreign investments in U.S. real estate. These factors collectively contribute to the dynamic and often volatile nature of the U.S. real estate market. Navigating uncertain real estate markets requires a strategic approach to mitigate risks and make informed investment decisions. Here are some strategies to help safeguard investments and capitalize on opportunities in the ever-evolving real estate landscape. Diversification. One effective strategy for mitigating risks in uncertain markets is diversification. By spreading investments across property types, locations, and asset classes, investors can protect against market volatility and potential bubbles. For instance, an investor might allocate funds to residential properties in urban areas, commercial real estate in growing suburbs, and shares in real estate investment trusts, REITs. This approach minimizes exposure to specific risks and ensures a more balanced portfolio that can withstand fluctuations in the real estate market. For example, while the residential market might experience a downturn, commercial properties or REITs could remain stable or even perform well, thus balancing potential losses. Diversification helps in hedging against regional economic downturns. For instance, if the West Coast housing market suffers due to tech industry layoffs, investments in the Midwest's industrial real estate might remain ineffective. By incorporating various property types like retail spaces, office buildings, and industrial properties, and investing in different geographical locations, investors build a resilient portfolio capable of enduring market uncertainties. Market research. To make informed decisions in real estate investing, conducting thorough market research is essential. Utilizing resources and tools such as real estate market reports, data analytics platforms, and investment calculators can provide valuable insights into market trends, property values, rental yields, and potential growth opportunities. By staying informed about local market conditions such as neighborhood demographics, local economic factors, and regional infrastructure developments, investors can make well-informed decisions that align with their financial goals and risk tolerance. Understanding these factors helps investors assess the attractiveness of a location for investment and predict future property demand and rental income potential. Regulatory changes. Moreover, regulatory changes such as Fed rate increases, zoning amendments, and tax policy adjustments can significantly impact real estate investments. An increase in the Federal Reserve interest rates can lead to higher mortgage costs, potentially reducing affordability and dampening demand for housing. Zoning amendments might restrict certain types of property developments or alter the density allowances, affecting property values and investment strategies in specific areas. Tax policy adjustments such as changes in property tax rates or incentives for real estate development can also influence investment decisions by altering the overall cost structure and potential returns on investment properties. By implementing diversification techniques, conducting thorough market research, and seeking professional advice, investors can mitigate risks, capitalize on opportunities, and make informed decisions in uncertain real estate markets. Stay proactive, stay informed, and stay strategic in your real estate investment journey. Market outlook. The real estate market is expected to be mixed, with some areas experiencing a decline in prices while others remain resilient. National home prices are anticipated to be resilient, although there are pockets of weakness, particularly in regions that saw rapid price appreciation in recent years. Existing home sales are expected to be constrained by high prices and limited inventory. The multifamily construction sector is predicted to weaken as demand for rental properties is projected to soften. In contrast, the single-family construction sector is anticipated to remain resilient, with some areas still seeing strong demand. Institutional capital remains interested in the housing market, albeit with a more cautious approach. Strategies for buyers and sellers. If buying, it's prudent to scout hard, bargain hard, and look for deals in areas experiencing price declines. For sellers in a hot market, consider selling while prices are high. In cooling areas, it might be better to wait for a more opportune time. The overall outlook for the real estate market in 2024 is mixed, with some regions expected to see price declines and others remaining resilient. It's a time for cautious optimism and strategic decision-making, with a focus on finding the right deals in the right markets. Potential impacts of a bubble burst. If the real estate bubble were to pop in 2024, it could impact different regions and sectors unevenly. Markets that experience rapid price appreciation and speculative investment may be more vulnerable to corrections. Urban areas with high concentrations of investment properties or significant development projects could see sharper adjustments. However, predicting the exact degree and scope of a potential real estate correction requires ongoing monitoring of these factors and their evolving interplay. By staying informed, making strategic decisions, and engaging with a community of like-minded individuals, you can empower yourself to make sound financial choices and become a prosperous Realty Rockstar. Share and subscribe.